Welcome to the YFP Real Estate Investing Podcast. I'm Nate Hedrick.
And I'm David Bright. We're both pharmacists and real estate investors that believe that real estate investing does not have to distract from a meaningful career in pharmacy.
Each episode, we share stories that educate and inspire pharmacists to leverage real estate investing as a part of your financial plan. Hey, David, how's it going?
Hey, good, thanks. How you doing?
Good. It's late spring, starting to warm up out there, and it's been a good season. It's been odd, right? So we've got a lot of inventory that is not popping up like I normally would expect this time of year, but still tons of buyers despite high interest rates. So it's kind of a weird time, which I feel like is the theme of 2023 for me. It's a weird real estate year.
Yeah, and I think competitive for sure.
Yeah.
Which I guess the competitive part shouldn't really feel weird after the last few years, but it just feels weird that we're still that competitive. Like we tried to buy a house to flip a couple of weeks ago, and we were just shocked by how many other offers, hearing about escalation clauses again, hearing about people dropping inspections, like all those, like the market is on fire, summer 2022 tactics. I was just hoping that would be done, but nope, still seeing that. So all that chaos is right back.
Yeah, and it's despite those higher interest rates, right? Like I'm actually seeing a shift in some of the demand, for properties that are good rentals, and how that fundamental shift has changed because of the interest rates going up, right? That 1% rule, you used to be able to you didn't have to hit it and you could probably still find success. But with the higher interest rates, with the way that the competitiveness has increased, like you have to at least be at that and then some in a lot of cases to find a good rental anymore. It's a weird shift in demand for sure.
Yeah. And that shift in demand and kind of where the market is right now, I think is where we wanted just to take a deep dive as we start into this summer season here, just really working through what are the fundamentals and how has that shifted in terms of deal analysis and why some of this demand is very different on the rental side. I know we talked a lot back on episode 50 about how to run the numbers on a rental. And we went into a lot of detail on that 1% rule that we're talking about here. So just to quickly recap that 1% rule. And again, if this sounds just very confusing, please go back and listen to that episode 50. But to recap, that 1% rule is a rule of thumb that implies that if a property rents for 1% of the purchase price every month, you have a pretty decent shot at it being a pretty decent rental. But my inner academic wants to then jump up and down and say, you can't hang your hat on a simple rule of thumb, right? You have to understand the math. You have to understand the why behind that. And if that truly will make sense as a rental. And so, Nate, you and I both are in the Midwest, so we can break down some properties that are Midwest numbers. So again, there's calculators and things out there that we've put out there and talked about in episode 50, but can you break that example down a little further for a 1% rule?
Yeah, absolutely. I think, again, we're numbers people, so it helps to see the actual numbers. But let's say you've got, again, using Cleveland numbers for a second, I realize some of you listening in California are going to think that we sound crazy, but you can extrapolate these numbers just the same. But so let's say you've got a 4-bed, 2-bathroom house here with a 1-car garage in like a, B+ class neighborhood here in a suburb of Cleveland. Typically, you might be able to buy that for, let's say $200,000. And if there's a decent rental demand in that particular area with that many bedrooms, that type of property, that type of area, it might rent for $2,100 a month, right? So you buy it at $200,000, it rents for $2,100 a month, and you're basically beating the 1% rule. Again, 1% would be $2,000 a month. So then you have a pretty good idea that it might be a good rental. But like you said, David, it's just a rule of thumb. It's a gut check to see if further calculations are worthwhile, but it doesn't necessarily tell you if it's a good rental. It just tells you that it might be, and it's worth investigating a bit more.
Yeah, I like that. It's kind of the first pass of like, does it make sense to do more math? Because you don't necessarily want to get out a spreadsheet and do 15 minutes of deep dive math on every property that hits the MLS on a given morning. So what's an example of a property that wouldn't check these boxes where you could use this 1% rule to identify the kind of waste of time houses?
Yeah, so there's two directions it can go. But the one that I think is easier to see very quickly is like, let's take that exact same house, but in a really nice suburb, right? Really high-end schools, nicer home. The rent values might not be going up nearly as quickly, but the property values do, right? So that same house might be $300,000 instead, and the rent is now only $2,200 a month, right? You're getting a little more in rent, but you're paying an extra $100,000 to get it. And so you're not even coming close to the 1% rule now, right? It's never going to rent for $3,000 a month. It's just not. And so you're not even close to that 1% rule, and it might not be worthwhile to consider that property as a result.
Yeah, I think that's a really good example because that shift in value does happen pretty quickly in some areas, and it's interesting how the rent doesn't follow that. So,
Mm-hmm.
as you know, the 1% rule too is that's not something we've come up with. You could read that in a bunch of books and hear that in a bunch of different podcasts and blog posts. If you Google 1% rule, it's all over the place in terms of rental guidance, right? So,
Mm-hmm.
but there's been a lot of discussion lately that I've heard on why the 1% rule may be less valid in today's market than it was 18 months ago. And you hinted at that a minute ago. So, Nate, can you walk us through what's the root of that debate? What has changed to make the 1% rule less valid?
Yeah. So if you think about why the 1% rule exists to begin with, the idea is that you're really trying to find, is the rent high enough to offset some of the purchase price? It doesn't tell you much about the other factors that go into that, like taxes, interest rate, so on. So when you say like, is this still valid today? The biggest thing that's changed is it's just two words, right? It's interest rates. When you could borrow 4% on a mortgage previously and cash flow at a 1% rule house, that same house is now selling for more than it was before, and it may be an 8% rate, right? Double the interest rate that you had before. And that creates a much higher monthly mortgage payment, which starts to mess up that rule. So just again, using simple numbers, that $200,000 house, if that requires a 25% down payment, it's $50,000, right? That's a $150,000 mortgage. At 4%, and I did these numbers in advance, at 4%, you'd have a principal and interest payment of $716 a month. Okay. At 8%, that's $1,100 a month, or almost $400 a month higher in mortgage payments for basically the exact same house, right? You're not changing the numbers except for that interest rate. But now all of a sudden you've got to find another almost $400 just to cover your costs and start to cash flow. That's what's starting to quote unquote break the 1% rule we've used for so long.
Yeah, that makes sense. Although when you use those numbers, that sounds really staggering to go from 4% to 8%. And I'll bet that there's people out there that are watching the news. They may see some of these figures, and you see a lot of headlines where rates are about 7% right now at the time of this recording, at least as we're into May of 2023. So if we're seeing 7% in the news, why are you saying 8?
Yeah, I mean, one, for the sake of the example, it was easier. But two, when you look at, and I was actually talking to a client about this today, that if you're looking at buying a rental property with a conventional mortgage, you're not getting an owner occupied rate. The lenders are going to increase your rate because of the extra risk associated with an investment property. So the news might be talking about a 7% rate. And what they're talking about is, I'm buying a house and I'm living in it. What they're not talking about is the investment property rate for a conventional mortgage, which is usually a full 1% higher, sometimes even more. So 8% is pretty much in line with what we're seeing for people that are buying conventional with an investment property rate.
Yeah, and I think that's a super important point because as you go to plug this information into Excel, into some sort of calculator out there, then you don't want to plug in the wrong rate and assume the wrong payment. Otherwise, you're going to buy that house, have a huge surprise that it may not create cash flow. So if we break that down and we do that math for a second, if you were to put that into a spreadsheet, we might start to think that $200,000 house renting for $2,100 a month. You just talked about how the mortgage payment would be around $1,100 a month, but then there's other expenses too, right? Like there's probably $250 a month in property taxes, maybe $100 a month in property insurance, $200 a month in property management fees. $100 a month that you're going to want to set aside for the vacancy that will happen at some point when you're going to have a fund saved up to pay the mortgage for a month or two while it's vacant. Even $300 a month we might set aside for repairs, larger capital expenses, some of those things. And so if we subtract all of that off of the $2,100 a month, there's $50 a month left of positive cash flow at the end of the month. And that's assuming our math is right, everything goes well, it really does rent for $2,100 a month, all those things. So that's sounding less and less enticing than it was 18 months ago.
And especially if you compare that with, like you said, where the mortgage rates were back then, right? If all of a sudden that mortgage payment is $400 less because the interest rate is lower and everything else is the same, now you took that $50 in cash flow and turned it into $450 in positive cash flow. Like that's where you can start to really receive some benefit. And I think that's where the core of the debate is coming from. And again, this is actually a good spot for me to stop for a second and just plug that if the numbers we're talking about, if you want to see it on paper, you want to see it in a spreadsheet form, because that's how I operate too. We have a great spreadsheet that you can access. If you go to yfprealestate.com, right on the bottom of that website, the main page right there, it'll say download the spreadsheet or get the spreadsheet. I'm looking at it now. Download the property analysis spreadsheet. You click on that, you'll be able to download that spreadsheet that David and I use for free. Just put your information in and we'd love to send that to you guys. So definitely check that out if this is sounding a bit overwhelming.
Yeah. And as you dive in and you start to look at all the line items in the spreadsheet, I think there's another common misconception. One of the things that we often talk about is that, I just threw out there real fast, there might be $300 a month in repairs and larger capital expenditures, but there's hardly ever a month that there is precisely $300 on the dot of repairs, right? You may go 10 months without doing anything, and then you might have a water heater go out. Or you might go 5 months without anything, and then you might have to replace a storm door. There are variables to consider in that. And we go into a lot of detail in episode 41, which is where we talk about things like if you buy a house that has a newer roof, a newer furnace, if it has newer vinyl siding or vinyl plank flooring or other those durable features, that can really help to minimize expenses. So if you want to build out from that spreadsheet and figure, is that 300, is that 500, is that 200? How would I know? Episode 41 goes into a lot more detail if you want to back that math into the spreadsheet.
Yeah. And again, we haven't said this enough. Those numbers, that analysis is becoming even more important as those interest rates have really started to knock out cash flow. If you take that $300,000 property that we just mentioned, again, 25% down, meaning you've got, again, that $75,000. So you have a $225,000 mortgage. The principal and interest on that payment alone would be about $1,650 a month. With all the other expenses that we're talking about, that rental property could be something that you're actually paying out of pocket for those expenses. Your rent is covering your mortgage, but everything else, that's coming out of your pocket. That's not an investment. That's just a headache, right? You're just paying for it. So those are the kind of things that you have to start thinking about and making sure that it's truly still an investment and not just a desire, something that you want to do because it seems like a good idea.
Yeah, I think where interest rates sit right now, one of my expectations for the second half of 2023 is that investors are going to pull back a little bit on demand for rentals that are pretty far above that 1% rule. As you get out the calculator and you do the math, particularly thinking about down payment, thinking about all the capital expenditures, the repairs, all those variables may shake out that a property may still work above the 1% rule. Yeah, that may end up being okay, but when mortgage rates were historically low, it was really easy to buy a $300,000 house and rent it out for $2,200 a month and have positive cash flow. But at today's interest rates, that cash flow is gone. It could even be negative when you're that far apart.
Yeah, completely agree with you, David. And again, putting like my realtor hat on for a second, if I'm advising a client about a property like that, right? If they're bringing me a deal and saying, "Hey, Nate, let's go look at this house. It's $300,000. What do you think the rent's going to be?" I can't, in good conscience at all, sit there and say, "Yeah, it's $2,200 a month in rent. Maybe we could ink $2,300 out of it. I think it's a great investment." Like, it's just not anymore. Like, I can tell you, these are the numbers, and you're gonna lose money on that house if you're looking to cash flow. Just quite honestly, if it's an appreciation play or you've got another plan in place, maybe. But from a cash flow perspective, it's not going to work. So, I mean, again, in that kind of light, David, you mentioned flipping earlier. And I want to set that up as our first strategy that can make really good sense for the second half, right? So like maybe is that a consideration or how does this type of interest rate problem affect flipping considerations?
Yeah, I think that, we are still buying rental properties. So I don't know that there's this hard shift that we're taking to only house flipping, but I know that's something that we've been doing so far in 2023 is thinking more about house flipping because really, there's two key reasons. One is that there's a lot of demand, right? Just like you started off talking about how still competitive it is to jump into the market and to find houses, buyers are looking really intently for houses. And so if you can put a house out there that looks great, is safe, respectable, that can be a huge draw for multiple offers, waived inspections, all those kind of things. And so while that's painful on the making offer side, if you can be on the selling side of that can be a good thing, a good way to kind of time this market. So
Hmm.
That's possible. I think going into that too is that it could be a good time as material costs are coming back down. I know flipping was really hard last year, but with material costs coming down, contractors becoming a little more available, that can help as well. But I think the rental viability too, when we were trying to burr properties and buy those fixer uppers, rent them out, rehab, refinance, repeat, that worked really nicely with interest rates where they were. But like you're saying, it's not working really well right now. So if you are in that situation where you've bought something to rehab and you're hoping to rent it out, it could be a good opportunity to sell it for a gain instead.
Yeah, or you could do what I did, which was buy with a mortgage when the interest rates are low, take so long to rehab it that I then had super high interest rates and couldn't refinance it. So yeah, I'm living that right now with one of my rentals. So it's it's happening out there for sure. So I guess one of the things that we were thinking about was that, even though rentals might be a little less viable from a cash flow perspective because of the reasons that, we talked about, are there times, David, when it still might make sense to purchase a property or pick up a property that doesn't cash flow well?
Yeah, I think that's a really good question because we're hanging our hat right now on the fact that the 1% rule helps you to understand if there's going to be cash flow, and the rental property calculator helps you understand if there's going to be cash flow. But is cash flow what you should always be after when you're chasing an investment?
Right.
I know as a safety oriented pharmacist, I like cash flow because that's a little bit of protection. If something goes wrong with the property, if the rent ends up being lower than I think, or expenses are higher than I think, then that cash flow can create some cushion and it can create some immediate return on investment. But despite the fact that I do like cash flow, my wife and I did buy a property recently that is probably, when we're all said and done, going to be on the wrong side of that 1% rule. And it's probably not going to cash flow much at all. But we believe that area has a lot of
Mm.
potential. We're seeing all kinds of all kinds of renovation come into that area. We think that neighborhood's going in a really positive direction. This specific property has a new roof, new furnace, new water heater, new kitchen, new flooring. So we're hoping that expenses are going to be pretty low for the foreseeable future. And so putting that all together, yeah, it's definitely a limited cash flow play, but we're hoping that there's appreciation in the next few years.
Yeah, and so again, before you send us a bunch of hate emails,
Yeah.
audience, saying cash flow, it's at it has to be all or nothing, right? That's a great example of how cash flow isn't everything, right? You can play that appreciation game if you've got some confidence that's going to be where that market goes. Obviously, it's a bit more of a gamble, right? You're banking on the fact that area has to appreciate, that we're not going to have some sort of larger downturn. But if you can get close on cash flow and then you're pretty confident on the appreciation, like that can still be a good investment, right? It can still be a great option, especially if you have a lot of other properties already that are your cash flow options. And then this becomes more of a speculation in terms of, okay, I'm going to diversify and I've got a couple of properties that I'm going to bank on appreciation working out. If it doesn't, the portfolio itself is still going to be okay. Yeah, those properties might lose a bit of money, but overall I'm going to be fine. And if it doesn't, if it goes great, then this is a nice way to diversify what I've already got. So it opens up your options too, especially if you have other properties already.
Yeah, I think this is where a lot of just kind of investing tolerance, risk tolerance, personality, I think a lot of that comes out looking
Mm-hmm.
at the overarching financial picture. Like, would that cash flow be really helpful for you right now? Or is that cash flow kind of it's a luxury that's not really necessary? And do you have some bandwidth to do some kind of speculation on appreciation and things like that? But if that kind of risk sounds just not fun at all for you, then there are other people doing flipping. Like we just had Jenny and Mike back on episode 98, and they mentioned how they flipped a house recently for essentially the same reason. They got to the end of the project, the cash flow wasn't going to be as strong as they hoped, but they had created value because they bought really well, they renovated very intelligently, and they had a lot of equity at the end of that project. So they were able to sell and get some immediate cash and some quick profit there. So, house flipping as a strategy, I think can certainly work in today's market. Nate, I know that you're helping buyers to move from their first home to their forever home. Like we are seeing that kind of transition even in this
Yep.
market with interest rates where they are. And there's a lot of considerations with what to do with the old house, the former house. So the second strategy we wanted to talk through today, I was hoping you could kick this one off, keeping
Sure.
a former primary residence as a rental, converting that primary residence into a rental instead of selling it. And why might that make sense in the second half of 2023?
Yeah, I mean, it's in some cases a luxury that not everybody can pull off, but if you can, right, if you can hold both of those mortgages for at least a little bit and then turn the old house into a rental, like there's some options there, especially when we talk about the interest rates and what they were just a couple of years ago, right? How incredibly low those interest rates were and how it can lead to cash flowing opportunities. You may not have missed the boat if you didn't buy an investment property then. If you bought any house then, you might already have that investment property and not even realize it, right? So what we're seeing is a lot of people that either bought a house in the last 5 years or refinanced in the last 2 or 3 years. They might have a really low interest rate. Let's say it's 3% or 3.5%. And now they want to move to a different house. I think there's a play to keep that property rented out because it has so much more potential now as a cash flowing rental opportunity than it may have done when you bought it to begin with. And again, if you were to take that exact same capital and redeploy it somewhere else, the interest rate you're going to get on that new property is going to be absolutely crippling from a cash flow perspective. So it's a good way to kind of keep a property you already had that may not have ever been looked at as an investment and sort of turn it into one.
Yeah. So if we go back to some of the examples you talked about earlier, you talked about that $300,000 house in the nicer
Mm-hmm.
suburb that might rent for $2,200 a month, and how that'd be a terrible investment if you had to go buy it today. But if that
Mm-hmm.
was the house that a pharmacist was living in, and they had an owner occupant loan at 3%, because again, owner occupants always get better rates than investment properties, and if you refied years ago, definitely could have been 3%. The principal and interest payment would only be about $950 a month at a $225,000 loan balance. So if the mortgage is $950 and the rent is $2,200, we can splice in the rest of those numbers, but that starts to look like it could work, even though it's nowhere near 1%.
Yeah, it's crazy how much that interest rate can really start to matter. I mean, and again, the other thing that you're not even we didn't even mention too is that same house, right, probably isn't $300,000. They may have bought that house for $200,000, and then they refinanced to a 3% rate a couple of years ago. Put 10,000 down. Now they only owe about $175,000. So that could very well have an $800 a month principal and interest payment on a house that's worth over $300,000 today. I mean, talk about cash flow. That's where you can start to find it.
Yeah, and that makes sense. If they bought it a few years ago, they've paid down that mortgage a little bit. Now it's only $175,000 of mortgage with a really little down payment. Principal and interest payments really little. So, a lot of people will probably want to sell that house though, because they're looking at, I owe 175, it's worth 300. That could really help me with the down payment on the new house. So Nate, what's really the advantage then in this case to keeping that prior house as a rental?
Yeah, I think it makes a little bit more sense if you put the numbers in there, right? It's easy to kind of talk pie in the sky, but I'm a numbers person. Again, we've done this with rental math before, but if I plug some numbers in, and again, we set this up in advance to make it easy, but let's say you put in 300 a month for property management, 300 for repairs and bigger capital expenditures, 150 a month for that eventual vacancy reserve, $400 a month in taxes and insurance. You've got about $1,150 a month in non-mortgage expenses, adding up all those things. So just remember $1,150 in your non-mortgage expenses. And if you add that to the $800 or so mortgage payment that we just predicted, you're at about $1,950 a month in total expenses. So now if we're looking at your rent, again, $2,200 a month, there's a positive cash flow there of over $200, $250 a month that basically you're able to put in your pocket because of the incredibly low interest rate that you had before, right? That same property being bought by somebody today with an 8% rate, heck, even a 7% rate or a 6% rate, isn't getting anywhere near that same cash flow on what was looked at as a bad deal is now suddenly a good deal because of the interest rate you're able to achieve.
Yeah. So it sounds like what you're saying is you could move out of that house. You could keep that property as a rental. And even though it's not anywhere close to the 1% rule, and even though if you were going to look at it as a purchase situation, it would be a bad deal. In this case, it could be a good property in that it would generate cash flow. And in addition to the cash flow, then you have a second property that you would own that could have that eventual market appreciation, the tax benefits, all the other things that we talk about in addition to the cash flow.
Yeah, exactly. And like I said before, appreciation isn't a guarantee. I never like to bank on appreciation, right? I'm not going to buy a house just because I think it's going to appreciate. That to me is just full speculation. And so, I don't know that I want to bet on some areas, but there are other parts of again, for me here in Cleveland where I'm really optimistic about that future growth, that opportunity. And so even though it's not everything, I know that if I can get some cash flow out of a property and I know the decency of that market, I can really buy in and hope for that appreciation to be the icing on top when I do sell that property someday down the line. And again, I think that also highlights how important it is to know the local market. Because I can tell you, again, there's other neighborhoods here in Cleveland where I would not buy for appreciation at all, right? Even if it did cash flow, I still probably wouldn't buy it, right? Because it doesn't make a lot of sense. And so that's why I think knowing that local market is so important wherever you are. It's one of the reasons we have the concierge service. I mean, if you're looking to buy an investment property somewhere and you need a good local agent, like that's the place to get started. So again, I'll plug our website. It's a great place to get started. YFPrealestate.com. You can sign up for a call with me and we can help you get connected with a great local investor friendly agent so you can get off on the right foot. Make sure you have that local knowledge in your tool belt when you're trying to make these decisions, because it can be as we've shown with the numbers, make or break just to have that number right.
Yep. Yeah, I think that the location, that market nuance is very important. I think another thing when you're analyzing your own house as a potential rental is to think about it from the standpoint of a tenant, what they would like, and to think about it from the standpoint of someone that has to then maintain this house that you're no longer living in. So kind of like we mentioned back in the season 1 of the podcast, episode 41, where we talk about all those repair costs, that's the time to be thinking through if your roof is 25 years old already, if your furnace is 30 years old already, if you've got older carpet that's going to need to be replaced soon, all those things, that might start to think that, even if a cash flow is $250 a month, it's going to take a long time before you save up for enough for a roof. Or the other hand, if you bought the house recently and already had all those things new, you've only lived in it for a few years, so that roof is 3 years old, the furnace is 3 years old, yeah, maybe there's a much lower risk of impending large expenses, and it might be more viable of a rental from the maintenance standpoint.
And I guess, we should say too, great points, but we should say too that, just because you got a low interest rate and just because it might be a good rental, like it doesn't mean it's going to necessarily be one, right? It may not cash flow. It may not be worthwhile.
Mm-hmm.
You have to run the numbers on this. This is not a thing where you can just guess and say, well, Nate and David said I should keep my old 3% rate and rent it out. Like, no, I didn't. I said, go do the math, right? Get the spreadsheet, go to the website, do the actual math, because that's how you're going to figure out what to do, right? We don't make these decisions based on gut checks. We start the decision based on a gut check, and then it's all math based, right? Looking at the actual spreadsheet and figuring out what to do.
Yeah, and particularly too, because just because a house cash flows doesn't mean it's a great move for your overall financial plan. It could absolutely make sense for you to sell that house and put that, that captured equity, that maybe $100,000 in this case that you'd walk away with. Maybe it makes more sense to pay down student loans, or maybe it makes sense to make 100 other financial moves. But if we just put on the real estate blinders for a minute, it can be a worthwhile exercise to do that, to go grab the spreadsheet and look at all that.
Yeah.
I think another hiccup that could come into this is on the mortgage lending side, right? As far as qualifying for a mortgage, there's a lot of factors in there. Nate, you walk a lot of buyers through that as a realtor. So can you talk for a minute just about how that qualification process may be easier or harder if you're trying to keep a previous house as a rental? And do you need to refinance that loan in order to rent out the house, or can you keep that mortgage without refinancing?
Yeah, I get this question a lot, like, oh, if I have an owner-occupied loan, I can't rent it out. So I'll start with the second part of the question because I think that comes up a lot. Generally, there aren't restrictions. Once you've lived in the house for a year, that would prohibit you from moving out and renting it, right? That you're not prohibited from doing so because of the lending. Even if you've got like an FHA type loan, if you've lived in there for the year allotment, again, it's usually a year, you're in most cases good. If you're concerned at all about that, you can check with your lender. Like, don't try to hide anything from them. Go to them directly and say, hey, we've been here for 2 years. We're thinking about moving out and renting it. Any restrictions on our loan with that? Any concerns? Better to be upfront with them and ask those questions first than try to figure out things on the back end. It's always cleaner that way. And then to answer the first part of your question, regarding mortgage qualifications, again, I'm not a mortgage lender, so this is a pretty complex topic, but much of the qualification part has to do with your debt to income ratio, or DTI. And so if your debts are being offset, or being added to rather, by this other property, that could potentially mess up your debt to income ratio, which might mess up your qualification.
Yeah, I think you hit the nail on the head with just being transparent with the loan officer too, because if you explain all of what you're doing, they may even be able to give you some direction for what you could or should or shouldn't do, or those kind of things, in order to count
Mm-hmm.
rent as part of the income. What would help to offset some of those debt costs and the mortgage on the former primary residence that would become a rental property? Do you need to have it rented out, or is your debt to income ratio in a spot where you can keep that house and it's not a problem? So yeah, definitely getting all those cards out on the table and getting guidance from a good loan officer that can help you work that math and figure out, is it possible to keep that former house?
Yeah. And like you said, just that transparency piece, be as transparent as you can. So one of the things I wanted to kind of expand on that we started to talk about, I think, is that if you think that keeping the house, like again, let's say you move out, you're buying a new place, you've got the old house, you're thinking about what to do with it. If keeping that former house could make sense for your overall financial plan, and it feels like it's like this once in a lifetime chance, right, to have this low interest rate. We might not ever see 3% again. So how do I, what do I do with this, David? Is there a reason to keep the house even if it doesn't cash flow, like even if it doesn't cash flow great? Does it feel like just the 3% you can't possibly walk away from that?
Yeah, I think it's a good mental exercise just to see if there would be a reason, because I don't know, like we've said
Mm-hmm.
earlier, just because it's a 3% loan doesn't mean that you should find a way to keep it. Yeah, we may not see rates low like that for quite some time, but I don't know that enough is there. But before the show we came up with 3 reasons that would be at least reasonably okay arguments where you might want to consider keeping a primary residence as a rental, even if it doesn't produce a lot of cash flow. And I think the first one is that having that rental can be really good training wheels if you want to decide to become a landlord, or just really evaluate if this is for you. Because you could always rent that house out for a year or two. And if you don't like being a landlord, then you sell the house. You're going to sell it anyway. All
Right.
you're doing is delaying that sale while you just pretend and try on being a landlord. So it may not create a ton more work. It's not like going out and buying a house and then discovering you don't want to be a landlord and having to sell it. That could be a much more complex situation. So I think second reason is, although current market conditions may not support a ton of appreciation like we saw in the last couple of years, the hope would be that if you hold on to the house for a decent stretch of time, the rent will slowly increase, but your mortgage will generally stay the same. So the cash flow could happen over time. If you increase rent $50 a year, another 50, another 50. After 4 or 5 years, that could be $200 or $250 a month in cash flow, even if it was cash flow neutral initially. Because again, although your escrows, your taxes, things like that may change a little bit, the principal and interest should stay stable if you have fixed rate mortgage.
Mm-hmm.
I think the third one is it may not be viable for an investor to buy that same property right now with current interest rates. So there may be very limited rental supply at some of those price points in some of those neighborhoods. So that would be where checking with a good realtor or property manager, they may let you know that, you think it would only rent for $2,200 a month, but we have such crazy demand right now. You may be able to get $2,700 a month. And that could shift the math pretty substantially.
Mm-hmm.
You may end up with cash flow you didn't think about just because of how quickly rents have gone up and how much demand there is right now in the market.
Yeah, great points. I love it. So I think what we've really talked about today is just all the things that you should be considering when looking at the current market, right? And how we're going to handle the back half of 2023. And just some of the pieces that you might not have been thinking about before, hopefully are now kind of in your head, whether that's thinking about house flipping when you had been previously thinking about long-term rentals, or maybe it's about actually going ahead and moving out of that property so you can keep the old property as a cash flowing rental property, right? You've got options is kind of the point. And so unless you're evaluating those options, you'll never know if they're viable or if they're going to be good for your financial plan. And so you have to be able to do the math. You You have to be able to look at these things so that you can make an informed decision.
Yeah, Nate, I really like that focus on the why. I feel like that's so important, and to keep an open mind to how shifting market conditions can always play with that why and what strategies might make sense in different markets, whether that's short-term rentals or long-term rentals or live in flip or fix and flip in a house you don't live in, or keeping a primary house as a rental after you move out. So many different strategies there. And not that we're even advocating for one over another right now, just throwing out ideas and how those ideas may shift as market conditions shift. So, and I particularly too, because real estate investing is only one part of the overarching financial plan. So before you choose to keep a high equity property as a rental, or before you get into house flipping, please consider whether that aligns with the rest of your financial plan. So, other strategies may be a better fit, even if they weren't things we talked about. But yeah, these felt like two really interesting things to talk about at this part of the market season.
Awesome. Well, hopefully that's helpful to all of you out there, especially if you weren't considering these things before. If you've got a property or a question or an idea about something we talked about today, we'd love to hear more from you guys. Head on over to the YFP REI Facebook group. We'd love to answer questions you have about this. Heck, throw some specifics in there and we can give you our opinion on what we might do in that situation. So we're always happy to do that and engage with our audience that way. So we'd love to see you on our Facebook group. You can also, again, go to our website to get the spreadsheet that we mentioned a couple of times. That's on yfprealestate.com. There's also a great guide you can download there. So lots of resources available to you. Definitely check those out. And again, hopefully this is helpful and gets you ready for the back half of 2023. So with that, have a great rest of the week.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard in today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with us, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group.
As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content of this podcast is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with their financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and therefore may not be accurate at the time you listen to it. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.
Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.